Okay, welcome back, class. So, once again, we just finished up chapter 9, which is a very, very small chapter, but it could be useful if you do planning on opening up a real business. Now, the one thing that we need to do is chapter 10, because chapter 10 is actually going to be very, very important, especially if you're dealing with customers and you allow giving customers an account, or you allow them to owe you money. So chapter 10.1 is going to be talking all about receivables and what you do when those receivables become bad debt. So first off, what is a receivable? Pretty straightforward. It is when you allow or you give your customers an account that allows them to make a purchase in your store, and they pretty much give you an IOU saying they'll promise to pay you back, and you bill them. All right? And then you bill them for the amount that they charged you on an account for. And they either, you have options, right? You can either, if it's a notes payable, you can charge them interest on that, right? If it's a straightforward bill saying, I'll only give you 30 days, you cannot go more than that, then, you can give your options, right? So what this is it's some way to entice your customers to want to buy stuff from your store, but at the same time, right now, with, the vast majority of people, taking advantage of store credit cards and accounts and whatnot, that's also one of the dangers and risks of doing business is, are you sure that you can trust your customers enough to pay you back if you tell them, okay, I'll let you buy all my materials, you owe me money then, okay? So once again, so when we're dealing with your customers and we place everything on an account, which is an accounts receivable, you are responsible to go after and collect all the information from your customer, and you are responsible. If they do not pay, you're also responsible to either count that as part of your sales, or you write it off as bad debt. Okay, so once again, when we're dealing with receivables, can you trust your customers 100% of the time to make their payments? Okay, and that's why we have debt collectors. That's why most companies, especially corporations, right, when they have a huge chunk of receivables, what they do is they sell the receivables out to someone else, like a debt collector, so then they're responsible for claiming all the debt from other people. Okay, so a great example of this is Walmart. Walmart used to be able to do their own, debt collecting, right? Then they decided to transfer all of their receivables to Chase now, or not Chase. Shoot, what's it called? Capital One. They sold all of their receivables and made Capital One be in charge of collecting all the debt from the Walmart people who have their Walmart credit cards. Okay, Target does it too. Target goes to another separate debt collector, right? Back in 2012. With the whole fiasco, right? It's because they decided to sell their receivables to someone else. That someone else decided to hack the system and figure out and start taking money from other people. So that's the one dangers of having it too. But once again, just having your customers, allowing them to owe you on an account is already a risk of doing business, okay? Now, well, what happens when your customer decides to fault on their payments? Well, that's what we have to create a contra account for. So in this case, if a customer poses any potential, flags that they're not willing to pay, or if they file for bankruptcy, or, if there is, hardship going on. So again, if you have to be responsible for every single customer that you're billing and that you're allowing to give credit to. All of those people, you have to go after every single one of them. If you got some people that make their payments normally, you don't really need to worry about them. But again, you can never know or never predict what happens in a certain customer's circumstances, right? With the recession, right? With COVID happening, right? Everybody lost their jobs. They're no longer able to pay for their debt. So with all of these contributing factors, right, you have to create what's called the allowance for doubtful accounts, which basically is a placeholder, okay? Now, this happens during the course of the entire business cycle, okay? Meaning you don't necessarily have to write off your bad debt every month unless you choose to do so. But in this case, what this contra account does is it's a placeholder, okay? Because the one key thing that you need to do is that just because your customer decides to fault you on the first payment, that doesn't mean that they're going to fault on the second payment. What if the second payment they decided to pay like, oh my gosh, I'm so sorry, I forgot to pay you, so I double up my amount and I understood that I'm going to be charged a huge amount. Some people forget. It's reality. It's life. Or they have other pressing bills that they have to pay before yours. Okay? Another thing too is that if that were to happen, you also have to remember that hello?
Nicole's here.
Okay. All right. Other things that you have to remember is that okay, now I lost my track of mine. Okay, so other things that you have to know that some people, they may be those kind of people that says that, no, I don't want to pay you. They could be straight up like that. Or, no, I don't want to pay you. I don't have the money. I'm sorry. Stop contacting me. I don't want to pay you. And those kind of, customers, it's either you want to deal with them and you could be in a struggle battle with them for 6 months until they decide to say, okay, I'll give you the money. Leave me alone. Or even other places or other times like, you'll go in a battle for 6 months, and then at that point, it's like, is it worth it? Excuse me. Is it worth it to have to collect that money if it's costing you all this money to have to send them these letters? It costs all this time for you to go ahead and collect your money. If they only owe you a simple $100, is it worth it? At that point, you can just write it off and be like, you know what, forget it. I'm just going to write it off as a loss. Okay, so key factor that you need to know here is that when a customer decides to fault on their payment during the business cycle, like during its course of action, you should know these 3 things. You're going to know exactly who didn't pay. Obviously, you see the records, right? Who didn't make a payment, you automatically know who. Second of is you know exactly how much they owe you. So if they didn't pay you, then you know how much they owe you, that they didn't, the amount that they didn't pay. And then third, you know exactly when. So if it's January and all of a sudden March rolls around and you notice that this customer isn't paying you, then you know exactly when, right? Because obviously they didn't make a payment on February. Okay, obviously they didn't make a payment in March. Then you know exactly when it has happened. So those are the 3 key factors here. All right? Any questions in regards to the allowance for doubtful accounts?
No.
Okay, so now how do we use the allowance for doubtful accounts? Well, great question. Okay?
I do have a quick question.
Go for it.
Okay, so the allowance for doubtful accounts is a contra account. Is that a contra account to the accounts receivables?
Correct.
Okay, I just want to make sure because I know where the accounts receivables is. So I just like to keep, where the sub accounts go.
Okay, yes, no worries. So once again, it is a contra account to accounts receivable because that's what we're dealing with, right? We're dealing with people who owe us money, our customers, right? This whole chapter is about accounts receivable. Okay, so yes, it is a contra account to accounts receivable. So let's go ahead and dive into this example right here, right? First things first is I'm going to recognize that in this scenario that, so on December 16, okay, Mr. Sanchez buys $100 of toys from us on an account, right? And then he starts to pay it slowly month by month, right? Because we decided to finance it and say, okay, well, how about you give me, the minimum payment of $20 every month, and then you could, pay it off slowly. So he's paid on January, right? And then now it's March. So he missed the February payment, and he missed the March payment. And then he tells us he's filed for bankruptcy, right? And can no longer pay for his the amount that he owes us. So first things first is we first have to recognize the very first thing is what happened here. We sold Mr. Sanchez some toys, right? We sold $100 worth of toys. Okay? If we've collected on January and we collected it on February, but all of a sudden March, he decides to stop making his payments, then we can start going up and contacting him and say, well, hey, what's going on? Why did you miss your payment, etc., etc. And if he feels comfortable enough to tell you that he filed for bankruptcy, then you can automatically know right then and there, right? So in this case, if he's made $20 in January and $20 in February, so that means he still owes us $60. So in this case, because he's told us on March 20th that he filed for bankruptcy. So therefore, this is what I'm going to do. I created my contra account, the allowance for doubtful accounts, right? Once again, it's a placeholder / contra account. What I'm going to do is I'm going to remove his amount that he owes me still, right? He owes me $60 still, right? I'm going to remove it from my accounts receivable, and I'm going to move it into my allowance for doubtful accounts account as a placeholder, because there's one thing that we also need to know as well. He still has the capability or to still pay for his debt. Okay? Any questions there?
No.
Okay, so because he still has the possibility to pay us for his debt, therefore, right here, we're placing it in a placeholder called the allowance for doubtful accounts. We're removing the amount from my accounts receivable and placing it into the allowance for doubtful accounts as a way of saying, okay, he's not completely inactive yet. He still has a possibility to pay us. Okay? Now, let's talk about what happens about bad debt expense. Okay? So, what bad debt expense is it's basically an estimated amount of receivables that you know can be true that you won't be able to collect. So, here's just a little, another account that you have to use as an expense. This is going to be considered an adjustment, right? So that means this typically happens at the end of the year, okay? But most oftentimes, you can do it on a month-to-month basis. Just know that if you do keep writing off all that bad debt, bless you, no worries. So if you know that if you're going to write off bad debt every single month, your books are not going to look very good. It's better that you write off your bad debt towards the very end of the year because, once again, you never know what happens between on a month-to-month basis, right? A customer can choose to pay, a customer can choose not to pay. You may say no to this customer one month and then say yes to the next month, right? So on a month-to-month basis, it's not highly recommended for you to do bad debt, usually at the end of the year. Now, what does bad debt expense do? It's when you are taking an estimated amount of your accounts receivable, right? If all of you owe me money, So Alan owes me $100. Nicole owes me $75. Everybody owes me money, right? Now, on my business standpoint, how can I guarantee that Alan will pay his full $100 at the end of the year? I don't know. So, because I don't know, right? What if I said, Felipe, I can guarantee that Felipe will pay me, but then next couple months later he decides to not pay me, right?
Run my credit.
Well, obviously that's going to be, a precursor, but we won't talk about that. But the idea here is that if all of you owe me money, how can the company, me, the business, guarantee that I will receive all of my money 100%? I won't be able to. So there is a standard out there. Most corporations right now, their bare minimum can be anywhere from 5 to 10% of their accounts receivable are going to be considered uncollectible. Okay, now that's just a standard out there. It doesn't have to be something that you have to utilize in regards to this. It could be anything. It could be 1%, 2%, whatever it is, right? As long as you can make that assumption or make that estimate, then you should be okay. Now, of course, this doesn't happen until you run your business at least a couple years, right? When you see a trend in your customers, right? You have a whole bunch of more customers coming in, and you notice that one customer decides to not pay for their bill. So the one thing that you need to know is it is an estimated amount. You don't know who's going to owe you the money, right? Like I said, Alan could owe me money, Nicole can owe me money, or they could not pay me, right? I don't know who, but what I can do is I can make an estimated amount saying that as a collective, right? If all of you guys all owe me money, right? I'm going to take all of the amount that you owe me and I'm going to go ahead and calculate some kind of estimated amount that could be a possibility that I will never receive. Okay? And that's exactly what bad debt expense is. It's an estimated amount. You don't know who, right? Once again, I don't know if Alan's going to pay me back. I don't even know if Melinda's going to pay me back. I don't know. So that's one of the key factors here is that you will not know. How much? You won't know because every person has a specific amount of money that they owe me, right? I can't just say everybody owes me $100 or that they won't pay me $100. So in this case, that's why I have to create an estimated amount because I don't know who and I don't know how much. And lastly, I definitely don't know when you guys are going to follow me, right? It could be the very last day of the month, right? In December, right? It could be January. It could be March. It could be, May even. I don't know when. So that's the key difference between the allowance for doubtful accounts, right? You know exactly who, you know exactly how much, and you know exactly when. Here, we don't know because it's an estimated amount. We have too many people to calculate for, and we can never know when, a scenario, situation, circumstance. We don't know what their hardships will be in the future. So in this case, that is when you decide to use the bad debt expense. Okay? And once again, it is not a contra account. It is an adjustment. All right? You typically would do this at the end of a given period, right? So you can do this at the end of every month, or general rule of thumb is usually at the end of the year. Okay? Any questions in regards to the bad debt?
No.
Okay? So then, since we are on the bad debt topic, let's go ahead and explore what the different methods are. Okay? We have the direct write-off method, or we have the allowance method. Now, the direct write-off method allows you to directly take away from the accounts receivable account and write off the bad debt. Okay? Now, the reason why it's not recommended is because One thing is that it's for tax purposes only. For your position that you're learning right now, are you the tax accountant?
No.
No, you're just a plain simple bookkeeper. So in this case, this is meant for the IRS for tax purposes only. All right, where you get to write off your losses and you get to report it to the IRS, so then you can get your nice, deduction off because you're doing business. Okay, so there's a lot more details into what happens for the direct write-off. So once again, we're not going to learn the direct write-off, but you have to know that the direct write-off method does exist. And when you are or do become the tax accountant, this is what you're going to be doing to the books. Okay? But because you are not the tax accountant, and we're doing this as if we are just the regular bookkeeper or just the regular accountant, you must use the allowance for doubtful accounts method. Okay? Now, this is governed by Acct. Okay? Because there's a few things that you need to know, right? Acct, it tells you for your recognizing your revenues, but it also is also dealing with your matching principle, right? Does your bad debt expense match up with the accounts receivables that you've written off or the allowance for doubtful accounts that you've written off? Okay, so it is governed by Acct, and plus Acct tells regular accountants that they must use the allowance for doubtful accounts method. The allowance method. Okay? Now, there are two ways that you can do underneath the allowance method. All right? You got the balance sheet method and the income statement method. Okay? And once again, we do not do the direct write-off method. We only utilize the allowance method because we are just the accountant. We are not a tax accountant. We're not working for the IRS. So the direct write-off method, we don't care about. Okay? So now that we have this, okay, let's go ahead and introduce the two different ways that we can write off our bad debt. Okay? So first things first is we're going to recognize the balance sheet method. Okay? So the balance sheet, right, tells us a lot of things, right? So it shows us our account balances that we have, right? So for example, the balance sheet shows us all of our entire assets. Now, an accounts receivable is for sure an asset, okay? So you will have the allowance for doubtful accounts appear on your balance sheet because it's a contra account to your accounts receivable. So that means when you're using the balance sheet method, you need to recognize two things. Hold on, excuse me, I'm getting super distracted.